we now go to our managing trade receivables. So, what are the risks that are involved in us investing in trade receivable? That is default risk, or the customer might not be able to pay the amount due within the maturity date. That is actually something that is that we maintain at a low level. So we need to ensure that the customers are worthy of credit extension. That is why we check their background first. And actually, another thing that we consider here is the opportunity cost that is involved on maintaining those receivable. Instead of receiving them in cash, we extend an interest-free loan to them in such a way that they will be able to use that fund elsewhere while they have not yet paid to you. And the opportunity cost there is you could have used that money elsewhere as well. So we consider the 5 C's of credit in extending loans to our customers. So that is character, capacity, capital, collateral, and the conditions involved. So when we extend credit, actually we consider on whether we will be strict or we will be lax. When we are strict in our collection credit strategy or credit extension, we are being conservative. Actually, we are tight on our credit extension. Therefore, it is hard for us to extend credit. While in providing a lax strategy or aggressive strategy, we are being aggressive there because we are extending loan to people without the security of them being able to pay it. So that would have an effect on your overall working capital management in such a way that your credit sales. What would happen if you have a strict credit policy in your a credit strategy in your company? Your credit sales would not be that much. Would be lower as compared to a lax strategy. While collection rate, actually, if you are conservative or strict as to your as to your credit policy, you would have a higher collection rate as opposed to a lower rate at aggressive credit strategy, which in turn our accounts receivable balance in conservative credit strategy would be lower as compared to aggressive. And bad debt, since we are strict as to our credit extension, would be lower. While in aggressive, that would be higher because we are at the higher risk there. See that there is a trade-off here. You'll have lower sales under a strict policy, but have lower amount of bad debts. And collection expenses, since you are quite assured with the people to which you have extended your loan to in strict credit strategy, you would have a lower collection expense as compared to aggressive credit strategy. So in credit policies, actually, what do we do to motivate our customers to pay earlier or on time? We have cash discounts, wherein as to entice them to pay early, we provide discount if they pay within say 10 days within the period out of 40 days. On the first 10 days, if they pay, they would be able to enjoy the discount. The technique here as to someone who would loan or who would be the customer of these suppliers that offer cash discounts is you need to take the cash discount at the last day of the terms so that you would be able to enjoy the cash still while you would be sufficing the conditions of the cash discount. Credit period means that the credit days offered to a customer, meaning this would be the days we would be specifying this to our invoice specifically to remind them that that they need to pay within this period. Credit cap refers to maximum or ceiling amount of credit line allowed to a given customer depending on his capability to make credit payments. That is a perfect example of that is when in a credit card, there is a maximum allowable expense to be credited on your credit card. So that is your credit limit. So that once you're close to that limit, you will not be able to spend anymore unless you pay. Of course, if you paid your dues on time, then you would still renew that credit line or credit cap. Credit block is a credit department's actions where a customer is not granted credit line because of its current account becomes past due. When you're not a prompt payer, even if you free a portion of your credit line or credit cap, you would be blocked by the credit department because of your history of non-payment. That is a possible thing that could happen even if you settle your obligations with banks or with the client or with the supplier on that note. You might still not be able to acquire loans since you are not in a good credit standing. That is what we are mentioning earlier, that when a customer does not pay promptly, you as a customer, your credit rating would be harmed in such a way that you might not be able to get credit anymore. So the trade-off of that is you need to pay in cash on all the transactions that you will have, which is disadvantageous for the company because instead of using that cash elsewhere, you would now use it to pay for your obligations. Credit class would be classifying your customers according to the ability to which they can pay, and that means that when someone has a higher ability to pay, you would grant them higher limits on their credit. When do we decide to change the policy? It is advisable to change your credit policy when it would result to a net benefit overall to the company. So the optimal receivable balance, actually the formula here is similar to the Baumol model, which is similar to economic order quantity. So we have the square root of 2 multiplied by the total AR need multiplied by the cost per transaction divided by carrying costs. If you are computing for an amount here, actually the thing is you need to use carrying cost rate, and the AR need would be in pesos. Effective discount rate would be this would be the cost actually of giving up cash discount. That is discount rate minus 100 minus discount rate multiplied by days in a year divided by the period of the terms, which is discount free. Now let's answer this problem. So this is regarding tightening credit standards. C company feels that its credit costs are too high. By tightening its credit standards, bad debts will fall from 5% of sales to 2%. However, sales will fall from 100,000 to 90,000 per year. The variable cost per unit is 60% of sales price, and the average investment in receivables is expected to remain unchanged. The effective tax rate is 30%. What is the net benefit or cost of the firm's plan to tighten the credit standards? So to solve for this, we need to identify there are two items here: the decrease in sales and the decrease in bad debts expense. So for here, actually, what happened is sales fell from 100 to 90,000. So the decrease in sales would be, that is 100,000 minus 90,000, that is 10,000. But remember that this amount pertains to the sales value, at which only our only investment here would be the variable cost, and the thing that we will lose here would be the contribution margin. So that is multiplied by 40%. That is 4,000. So that is the lost contribution margin. Now we consider the next item, which is the decrease in bad debts expense. What is the original bad debts expense? That is 100,000 multiplied by 5%, or 5,000. Then we have the new bad debt, which is 90,000 multiplied by 2%, or that is 90,000 times 2%, 1,800, or when we deduct that, the net change in bad debts would be 3,200. So now we have our loss CM, which is 4,000, that is to be deducted, and the decrease in bad debts, which is a good thing, so that is a decrease in expense of 3,200, shall be a positive. Then the net benefit is 800, but still we need to find the after-tax net benefit, so that is multiplied by 1 minus tax rate, that is 70%. So we have 560 negative. So that is the net cost of the firm's plan to tighten credit standards. So does it mean that tightening the credit standards in this situation would be good or bad? It would be bad, because it would have a net cost of 560. So it is okay to have a lax credit standard in this situation, because it has a net advantage. Now let's go to the next problem. So introducing a cash discount. M company currently makes all sales on credit and offers no cash discount. The firm is considering a 2% cash discount for payment within 15 days. The firm's current average collection period is 60 days. Sales are 40,000 units, selling price 45 per unit, and variable cost per unit is 36. The firm expects that the change in credit terms will result in an increase in sales to 42,000 units, that 20% of the sales will take the cash discount, and that the average collection period will fall to 30 days. If the firm's required rate of return is 25%, what is the net benefit or cost of offering a cash discount? So we need first here to determine the amount that will be spent on the cash discount, which is, it is mentioned here that on the new sales value, which is 42,000, you would have multiplied by 45 to get the sales in pesos. You would have 20% availing of the cash discount, that is 2%. So how much would that cost us? So that is 42,000 multiplied by 45 multiplied by 20% multiplied by 0.02. That is 7,560. So times 45 times 20 times 0.2 rather times 0.02. Okay, now we go to, that is the cost of the cash discount. Now we consider the accounts receivable released as a result of the cash discount introduced. The thing is, how much was the previous investment in accounts receivable was. That is 40,000 times 45 for the sales of 1,800,000. Then your average AR is multiplied by the previous average collection period is 60 divided by 360. So that is your old average AR, which is 300,000. Now the new average AR would be 42,000. 42,000 multiplied by 45 multiplied by 30 over 360. We will have, that is 42,000 times 45 times 30 divided by 360. That is 157,500. So effectively, your investment in AR decreased by 142,500. But that is not all your investment in that accounts receivable, because of this amount, only the cost per unit is the amount that you actually shelled out. So that is, we multiply this with 36 over 45 to determine the cost of AR, that the cost of the of that AR that is released from the operating cycle as a result of introducing the cash discount. So that is multiplied by 36 divided by 45. So that's 114,000. So of this 114,000, you can get a required rate of return that is 25%. So we multiply this by 25%. So the return that we will generate here would be 28,500. Now we deduct the 7,560, which is the cost of the cash discount earlier computed. So 20,940 would be the net benefit of offering this cash discount. So does it mean that we must offer this cash discount? Definitely, because it would result to a net advantage of 20,940.